show. We've heard a lot about the different forms of finance, and of course, as Kenya continues to grow as an economy, we're always inviting different kinds of financiers, whether they are international financiers or local businessmen who wish to invest in government, in industry, and also in businesses within the country. But there's a particular form of financing that we really don't know a lot about, and yet it is one of the fastest growing forms of financing. It's Islamic financing. And today that's really what we are exploring. What is Islamic financing? What is Islamic banking? Islamic finance? How is it different from what we conventionally know from what I would call the Western precepts of financing, of banking, and of insurance? So that's what we're discussing today. My name is Renee All. This is Capital FM TV, and welcome to the show. Now, on the show today, we have one of, I would say, the world's leading Islamic financiers, Ali Mohammed. Welcome to the show.
Thank you, Renee.
Now, let's just hash it out straight away with the basics. What's different about Islamic financing from what is conventional financing, the high street banks, and the things that we know?
Okay, let me start by explaining what is Islamic banking. Now, Islamic banking and finance is actually banking and finance system based on Islamic principles, which includes non-interest based financing. So there's no interest element of financing with Islamic finance, but also guided by the Islamic principles. Now, we can go later on what are the Islamic principles of financing. And those are investing in non-permissible investments, and that can be alcohol industry, pork industry, gaming, entertainment, tobacco, conventional financial services, and defense to an extent. Yeah. Now, the main difference between Islamic banking and conventional banking, it's actually the interest-based banking. So let's say, can I give you an example? Let's say, Renee, you want to go to an Islamic bank, and you want to go to a conventional bank to get a product, let's say a car loan. Now, you go to the conventional bank, you ask for a car loan, they'll give you, let's say, 2 million shillings. You go and buy your car. Even sometimes you end up not buying your car. You might do something else with it. But as long as you pay your installments every monthly. So actually you got money and you're paying money. Let's say the same transactions happens to an Islamic bank. You go to an Islamic bank, you ask for a car, they'll ask you for your pro forma invoice, including the chassis number. They'll actually physically and constructively go and see the car if it's there. So what happens is the bank actually becomes the owner of the car, transfers the ownership of the car to the bank. So they will actually transfer the ownership once they've verified that the car is there. They'll buy the car and sell it to you, but you know the transaction price, so you know what the amount is and you know what the markup of the bank is. So what did you go to the conventional bank? You went, you got money for money. In the Islamic bank, you went and you got products and services for your installments. So here there's an exchange of goods and services. Actually, there's an asset. The underlying transaction here, the underlying of the transaction is the car. So in Islamic finance, there must be an underlying asset.
Right.
Yeah.
So juxtapose that example for working capital, because many small businesses today, of course, will be going to the bank to borrow for working capital requirements.
Yeah, or personal loan.
Or personal loans.
Yeah. Now, let's say if I was an Islamic bank and somebody came and asked me for a personal loan. Now, ideally, the personal loan can be, you can have a murabaha, which is a cost plus markup contract, or you can give them a commodity murabaha, which is also commodity-based cost plus markup transaction. Now, in simple terms, Renee, you go to the bank, you ask for 10 million shillings personal loan. The bank, Islamic bank, will tell you, Renee, we cannot give you But what we'll do is we'll actually acquire stocks of a Sharia compliant, of an ethical compliant company in the stocks. So what you'll do is you'll have your Nairobi Securities brokers account. So they'll put actually 10 million equivalent.
Okay, stop. We'll have about 10 million.
Yeah, let's say you go for 10 million shillings for personal loan to the bank. The bank will actually acquire Sharia compliant or ethical compliant stocks from the market. Now then, I think out of the 55 there, in my last research, there were only 13 which complied actually with Islamic principles. Right. Yeah, we'll go deep into that in a few minutes. What happens is you get the 10 million worth of stocks. You have your brokerage account. Let's say the bank will tell you, Renee, those are the 10 million. You can sell it immediately, or you can sell maybe tomorrow or after a week. What happens to the gains you get? That's the risk you're taking. If there's losses, that's also the risk and reward you're taking also. But here, you went for a personal loan. But what did you get? You got shares. You got shares of company worth 10 million, your loan. So this is a commodity. The shares are assets and liabilities of the company. Still, it's an asset. So in every transaction, there's an underlying structure. I don't know if the market in Kenya is so sophisticated to use that means of the stocks as an underlying asset. Some people do it with coffee. You can also extend this to coffee products, coffee, tea, flowers, any commodity-based, platinum, copper. Yeah.
Basically, my understanding then is that if I walked into an Islamic compliant bank and applied for a loan, for a personal loan, they would not hand over the cash to me as a conventional bank. They would find a commodity which would carry the cash, if I might use that.
Correct.
How does this work as a greater advantage compared to conventional financing, when you have this intermediate that is an asset or a commodity that is carrying the finance, if I can use that term? How is this an advantage, or is it an advantage?
Because
conventional financing?
I mean, this is the core principle of Islamic finance. You cannot sell debt. You cannot sell air. Something has to be physically constructive. I mean, in Islamic finance, we do not believe in time value of our money. So that concept does not exist in, let's say, me and you, we take 2,000 shillings, and we put it in a book, and we put it in a cupboard. Next year we come, we expect 4,000. No, it doesn't work that way. So we believe in the movement of assets. Now, every asset has a value. So, I mean, Islamic finance is all about movement of assets. It's about risk sharing, not risk transferring. In conventional banking, you remember we go back to the loan, to the car loan. Yes. Now, where the bank transferred the car to its name, so the risk is with the bank. The bank will actually sell the car to you, but at the same time, you will not be 100% owner of the car until your 5 years or 3 years tenure. Then the car will be transferred. Now, at this time, who insures the car? You or the bank?
Who does actually?
The bank. In a typical Islamic bank, the bank. Yeah, because so at the end of the day,
the risk lies with the bank.
Yeah, no, the risk is shared among you guys.
Okay.
The risk is shared among the bank and the customer. Now, the bank is not in the business of selling cars. The bank is in the business as a financial intermediary. They're there to make, they're there to make money, but money not in selling cars. So, but by taking the risk of that and sharing with you, that's risk sharing. In Islamic finance, it's all about risk sharing, profit and loss. No capital is guaranteed in Islamic finance. We can go there and let's say you want to invest, let's say, in a fixed deposit with the bank. Your fixed deposit is not guaranteed, but there's capital protection ways where you can protect your deposit. Because let's say the bank is the manager of your capital. You are the investor. You know, the bank can go bust, or they can invest in a loss-bearing company, and then you lose your. So that's the capital guarantee is actually not favoring the manager of that capital. Do you get what I mean?
Yes, I do.
Yeah.
So let's take a couple of steps back.
Yeah.
There's quite a bit to unpack there. First is the principle that whereas you're not paying back interest, so there isn't this idea of paying back interest. What you have instead is a markup on the
profit rate.
A profit rate.
Yeah.
And how do you work out that profit rate as the institution? Is it a fixed amount?
No, we benchmark it to the prevailing market rate, now, which can be offered by central bank, which can be offered by other banks, or even LIBOR, London Interbanking Offer Rate. So your question will be, maybe, is that not interest? It is, but let me give you an example again, because I like using analogy. Now, let's say, Renee, you have an orange juice shop. You are selling orange juice, and I have next to you a liquor shop. I'm selling alcohol. I'm selling 1 liter of alcohol, 10 shillings. Can I prevent you to sell your orange juice, 1 liter of orange juice, 10 shillings?
No, you can't.
I can't. If the market is accepting it, isn't it? There's a demand for the juice, the 1 liter, 10 shillings. I cannot prevent you. But what did you do? You just benchmarked your liter of orange juice to my 1 liter. But what is Islamically compliant is your juice, and what is Islamically non-compliant is the alcohol. Alcohol is forbidden, while juice is not. So that's the Islamic part of it. Now, we cannot, Islamic banks are in the market to make money. So we cannot go below market. Sometimes Islamic banks are expensive. And this is because this is one of the challenges that Islamic banks here in Kenya face, because there's lack of innovation, there's lack of product development. And we'll come to that in a few. To be honest, if the Islamic banks here were very proactive and actually going beyond that competitive advantage of being only Sharia compliant. Sharia compliant is not enough nowadays. What other products are you offering? Because as the customer gradually becomes clever, his demand of sophistication becomes more. Yeah.
So, still quite a lot and lots of points that we're going to come back to. But let's just get clear on a couple of things first. You spoke about Sharia compliant.
Yeah.
So quite apart from the goods and commodities in which one is allowed to invest in, not alcohol, not gambling, not pork, etc. What other tenets underlie the financing aspect of Islamic law and also Islamic trade?
Yeah. Good question, and that is called the industry screening. What we just mentioned, the alcohol, the gambling, the entertainment, tobacco, that is the industry screening. Now you have also the other thing that it's called the financial screening.
Okay. So, let me just stop you and ask you very quickly. Who screens the industry? Now
there's a group of scholars who are actually it's a body called Accounting and Auditing Organization of Islamic Financial Institutions, that has global Sharia scholars who sit there. And these are renowned scholars in the field of economics, finance, Islamic insurance, Islamic finance. Okay. And it's not only a certain individual that sets the parameters. No, it's a body, it's an accounting body, an Islamic accounting body. Now, there's the industry screening, which we talked about. There's also the financial screening. Now, in the financial screening, if a company is listed, you look at the debt to market cap of the company should be less than 30%. If the company is not listed, you look at the assets. The debt to the asset ratio should be less than 30%. Now, the reason being here, you don't want to invest in a company that is highly leveraged, because as an investor, you're not in the business of bailing out a company. You're there to invest for organic growth, capital growth, and to make money. And another screening is you look at its marketable securities, conventional marketable securities. Now we're talking about bonds, T-bills. Now over your market cap should be less than 30% as well. Now this is to avoid having conventional products in your bank. Yeah, and one of the most important one is non-permissible income. Now, the revenue that is generated that is non-Sharia compliant. Now, I'll give you an example. Let's say I invested in Nakumat. Now, Nakumat has a section that sells pork, a section that sells alcohol. I'll look at that income that comes from that, which is not non-permissible in Islam. Over the total revenue should be less than 5%.
Is it realistic to set such a goal in
It is.
non-Islamic countries?
It is very realistic because we are not there to kill the business. That's why, and we are not there. Now, if we said Nakumat is non-permissible, it is non-permissible. But guess what? There's a threshold. Now, if I'm an investor, an Islamic investor, I'll go into Nakumat, look at the ratio. If it's above 5%, non-permissible income over the total income, if it's more than 5%, I'll actually invest in Nakumat to dilute, to less that income, to become to zero,
So
to make it more compliant.
There's an element, therefore, underlying this of the greater aspect of, can I call it some kind of evangelism or some kind of neutralizing, if I can call it that. I don't know if that's a correct word. Or of diluting, as you've called it, of diluting the non-compliance and
Income.
Yes.
Yes, because our religion does not, we do not sell pork. You cannot sell alcohol. But at the same time, you don't want to kill the business. So you go into with the intention of lowering that income. Now, I mean, is it, okay, you can say, why don't you go to a supermarket that doesn't sell alcohol? You will never find. Unless I'm in the Middle East where you have the likes of the other supermarkets who are compromising. But that is, Islamic finance is not there to kill businesses. We are there to transform business. And I'll tell you one thing. If I'm an Islamic investor and invest in a company and I reduce the debt, now let's say I invest in a company where the debt is 3%, the threshold is 30%. I'll come in, probably I'll pump in more money to reduce. I'll restructure the loans. I'll get them maybe Sharia compliant loans with better terms. Because Sharia compliant loans, you have better terms than conventional. Because if you cannot pay the loans, you get a grace period. You get a grace period. The bank will understand you. Actually, the bank is there to understand what's your problem so we can fix it. Now, let's say an example, you bought a house and you couldn't service your loan. You couldn't service your mortgage. The bank will give you a grace period of 6 months to 9 months, as it should be, Islamically. The bank looks at the needs of the customer. We are not there to burden the customer. We are there to relieve the customer from the problems. So we'll give you 9 months. Maybe you didn't have a job for 9 months, then you find a job. Then we'll actually restructure it again for you. And guess what? What happens if you don't even get a job? So the bank will tell you, Renee, we're selling your house at a market price. You've actually settled 40% of the mortgage. So 60% is only remaining for us. We'll sell whatever comes up after we recoup our installments, we recoup our financing, we'll give it to you. That is Islamic finance for you. But Islamic banks here in Kenya are not that sophisticated. I don't know why, but in England you have the Islamic Bank of Britain. It has a waiver. Yeah, we need waivers. We need the central bank. We need the regulators to be more proactive than reactive. Unfortunately, the Central Bank of Kenya and the regulators here gave people the license without understanding the whole.
Yes.
You cannot run before you start crawling, and you cannot. You have to crawl first for you to stand up and start running. Now, what central bank and the other regulators did is they went. They are actually on a speed mode. The speed that they are in, it's a Formula 1 speed. To me, my advice to the regulators will be understand Islamic finance. It's a market that is, it's the only financial market that grows 25% year on year.
Which brings us squarely to my next question, which is, what do you think is attributed to this almost seemingly sudden and very quick growth of Islamic banking and Islamic finance around the world?
If you go back to the recent crisis in 2008, if you look at all these hedge funds, if you look at all these financial institutions that did collateralized mortgages, most of the banks actually the underlying was debt. If you look at the underlying of most of the Islamic financial institution transactions were assets, which actually they can be referred to, you can actually go and claim back to. So if an asset is there, you can go and claim your share of that asset, whether it's in a form of a bond, you're holding a bond and an Islamic bond, which the underlying was a building, you can go back to the building. But conventional, they're all debt, collateralized CDS, securities which were backed by debt. So when one goes bust, there's nothing you can go. There's nothing.
Theoretically, I can ask the same question of the building, because as we saw in the crisis in the US, one of the things that was corresponding was the complete collapse in prices, especially prices of properties. So that if you did have, coming back to your example, you have the building, then you're still in a little bit of a crisis because your building was valued at X. And of course, by the time the crisis came round, it was X minus a certain number of points.
Yeah, once we need to understand what happened in the US. It was people were selling insurance, or selling mortgages. Actually, mortgages were split into three. There's the insurance and the interest and the principal. Now, the principal was sold to a hedge fund in Asia. The interest was sold to in Europe, and the insurance, AIGs and all these likes him. I don't want to mention names, but they reinsured everything. So when one goes bust, it's a domino effect on the rest. So when our property is valued at a certain amount, and the beauty about Islamic finance is everything is traceable. You can go back to the asset, and the asset value is what it is. You cannot mark it up more than anything else. So let's say a building here is $10 million worth, it's $10 million worth. They'll issue a bond, and they cannot actually resell, they cannot split. You cannot split interest, and no, there's nothing. You are selling a whole coupon. It's a coupon that you're selling to the next customer. Now, let's say if I was to issue an Islamic bond on a 10 million value building, I'll issue that, and there's no splitting of the principal and interest and the insurance. No.
Yes, of course, it all comes as one entity.
It all comes at one.
Yes.
So there's nothing. No one can actually. Now, let's say, God forbid, the bondholder or the issuer goes bust. We can go back and sell the building, and I'll recover my value of my coupon.
If the value of the building should have gone down in the period between the transaction and the time of selling, who bears the risk?
The risk is bad. It's the originator. It's actually the issuer of the bond that bears the risk. But normally there's an underwriter as well. Against unprecedented circumstances or force majeure. But if you look at the historic value of the buildings here in Nairobi or anywhere else, they always go up, unless something happens. Islamically, the building, actually, I've never seen any transaction that the building has devalued.
Well, I was just thinking in the case of what happened in the US with residential properties in some of those cities.
Oh yeah, that was toxic.
Which was, yes.
What happened in the US is toxic. Even people were selling air. People are selling debt, which actually literally not existed, and people are insuring that debt. Imagine, you cannot catch debt, you cannot feel debt, you cannot see debt. Yeah, but the building, I can see it, I can feel it, I can claim it. Yeah.
So to whom is are the benefits of Islamic banking available? Do you have to also be Muslim, or does your business have to be, well, you've already mentioned it can't be more than 30% compliant. Who can take advantage of these of banking products specifically?
Actually, the screening criteria do not actually, it's not for the customers, it's for the investors. It's for the Islamic investors who want to invest in a company. But you as a customer, one of the misconceptions that we have is that Islamic finance is only for Muslims. Not at all. If you look at Malaysia, most of the people who are banking with Islamic banks are Chinese non-Muslims. Islamic banks, actually, once you realize the benefit of Islamic bank, you'll leave the conventional bank if it's properly implemented, executed here in Kenya. I'm saying, now if you look at insurance, Islamic insurance, if you want to talk about it, there's more benefits for you to insure with Islamic insurance, because you as an Islamic policy holder, you are a shareholder of the company.
In fact, we'll be talking about insurance shortly.
Okay.
And so, that's really good, because there's some very interesting tenets within Islamic insurance.
So you, non-Muslims, Islamic banking is for everyone. It's for everyone with, who wants, capital protection, who wants to be ethical, who wants to be, you find that now social responsible investments initiatives are also coming back to become ethical. And if you look at the guidelines that they offer, normally 80% of it are Islamic. You have these guys, people who are issuing green bonds, people who are issuing, people who are issuing ethical, compliant products. Now people who are investing actually socially, they said, look, we don't want to be involved in interest. Yeah. Vatican is one of the biggest investors in social responsible investments initiatives.
I would imagine, though, that the Vatican would not be one of your targeted clients.
No, but they are one of the customers of an Islamic fund management in Europe.
Oh, right.
Yeah.
Right, well, didn't know that. I certainly didn't. So, in the event of default, because default happens for whatever reason, I have my business and you did stock it up for me, but I did not employ very prudent accounting procedures, or something happened, there was a force majeure. Actually, let's put force majeure to one side. In the event of a default, what then kicks in?
The bank will have to put the customer first. Now, this is Islamic banking for you. The principles are we share the risk, we share the profit and loss. We look at what happens. If it becomes, if it's because of negligence and we prove that it's negligence, you are liable.
Okay.
Yeah.
So you're liable to repay the debt.
Yeah, to repay the debt if it's negligence. But if it's not negligence, if it's because of other things, then here the bank becomes more the understanding. They give you a grace period to recover, and they look at ways to help you. The bank actually will offer you services to make your business much more better. Because if your business recovers, you end up paying them the finance, the debt. So that's the position of the bank. The bank will never put you in a place where you will actually be suffering. Unlike the conventional bank. Here the bank will offer you solutions. Yeah.
So, if you were to summarize the basic tenets of Islamic banking, what would they be, as you understand?
Islamic banking finance is a financing way where, it's a non-interest-based financing where the Islamic principles are met. And the Islamic principles are the ones we talked about, where risk sharing. Now, there's another aspect that we forgot to mention about this, also the Sharia board. Now, the difference between the conventional bank and the Islamic bank is the Sharia board, the governance part of it. Now, there's the Sharia board are the people who make sure that everything is according to the Islamic banking and principles. Now, under the Sharia board, you have the Sharia auditor, who audits every transactions in the bank that is according to the Sharia compliant. That's why you will never be in a place where the bank is gaining and benefiting and you are losing. No, it's a win-win situation in Islamic banking. Yeah. So the Sharia board are the 3 scholars or 5 scholars who sit on the board, advising the board on the Sharia compliance of the whole institution. They don't report to the board. Yeah, because otherwise there'll be a conflict of interest and there will be no objectivity, basically. Yeah.
You mentioned earlier a bit about the regulatory framework that is required for Islamic banking to be successful in an emerging economy such as Kenya's. What are you seeing right now as the challenges, and from a practitioner's point of view, what would you love to see that would enable this particular industry to grow, this particular sector of the industry to grow?
One of the regulatory challenges that are here are the governance, Sharia governance, harmonization and standardization across the financial institutions that are here, Islamic one I'm talking about. Now you'll find that a car loan product is not the same with bank A, B, C. They're different. Well, they're using the same, it's a murabaha. While one accounts differently for a murabaha and the other one. So it should be a harmonization and standardization of all these products. Secondly, it's on the corporate governance side, is in a new market where the Islamic finance is new. They should actually advise for a central Sharia board, where at the central bank level, where you have a Sharia board not reporting to the central bank, but working with the central bank in terms of aligning the regulatory environment, the regulatory platform, the standards, the Islamic financial standards, and making sure that product A is the same in bank XYZ, you know, instead of different. I mean, that is the main challenge that I'm seeing. And also there's no product innovation in Kenya. Now in Kenya you find that the Islamic banks that are here are very comfortable sitting behind, because the Islamic will get the business. Central bank should be promoting more banks to come, so the more sophisticated banks that come in, Islamic ones, the better products the customer is getting. At the moment, nothing is happening. Yeah.
Quite a bit of a ways to go then.
We are far behind. We are far behind. And Kenya, to establish itself as a hub, Islamic finance hub, the regulator need to pull its socks up big time. And the regulator knows where they can find people to assist them. I mean, if you look at the board of the central bank, there's no one who caters for Islamic finance. If you look at the Insurance Regulatory Authority, there's no one who will actually, while you're talking about Kenya is almost 20% Muslims. Yeah. So, I mean, you need people to, I mean, Islamic finance is something that will attract the Middle East a lot. The more products that are issued here, the more Islamic financial institutions that are here, the better it is. But I'm talking about it's better quality over quantity.
Yes.
Yeah. And the banks which are not performing, the central bank should take action. Yeah. Or the banks which are deceiving, the central bank should come. Because I don't believe that a car loan should be different in terms of structure with bank A, B, and C. If you go to the conventional bank, the personal loan are all the same. It's only the terms which are different.
Yes.
It's only the rates,
Yes.
but the structure is the same. Yeah.
Here it's more of a structural issue.
No, here it's more of a structural issue. It's more of an understanding issue. Unfortunately, we have scholars who sit on the board of the Sharias of this bank who are very qualified in terms of religious matter, but economics, accounting, and legal terms of the bank, it's a different ball game. What I'll advise the central bank is to put, career development program for these scholars to learn the banking system, to learn the banking product. Because I don't believe an imam from a mosque should be the chairman of a Sharia board of a financial institutions. When you talk about complex structures, nothing happens.
Wow.
Yeah.
Well, that's, I think Islamic Banking 101 is what we should call this, because that's exactly what it's been. Just a little bit about the basics of what Islamic banking is, on what it looks like, on what its face is like. Of course, you can find out a lot more, and we'll be coming back with a series of these, and also talking about Islamic banking, Islamic financing on the show in the morning, Capital in the morning, on 98.4 Capital FM. But hopefully that's given you a little bit of an insight on Islamic banking. We come out now and we're going to do another little session, which is going to be all about Islamic insurance and how that is different from conventional insurance. This has been Renee All, and many thanks to our guest Ali for coming in and for having a conversation with us. And I hope you've certainly learned something new. I certainly have.
Me too. Thank you so much.